Hey guys, Adam Rose, Vice President, Senior Loan Officer of Western Ohio Mortgage here in Sydney, Ohio. This is another episode of the Mortgage Guy Podcast, and this week we're going to learn a couple new things and what's going on in the market. And HUD introduces a new payment supplement to aid the struggling homeowner currently. So we all know over the last 18, 24 months, rates have been a little bit higher, payments a little bit higher, prices are high. So even though you're qualifying for this stuff on paper, due to economic concerns and reasons, some people are working less hours, making a little bit less money. They're starting to struggle a little bit making their house payments. So FHA came out and they just issued a new mortgagee letter establishing a new payment supplement loss mitigation home retention solution. I mean, they could have said it in some fewer words to get their point across. Here it is in a nutshell. So if you are an owner of an FHA mortgage and you've run into some issues, they are offering a so-called payment supplement. Okay, this provides mortgage servicers with an additional tool to temporarily reduce a borrower's monthly mortgage payment by up to 25% by modifying the mortgage's current interest rate. So, the payment supplement is meant to help those borrowers who cannot sufficiently afford or they need some assistance by FHA, and they want to keep you in the home. Right? They don't want to be foreclosed, or they don't want to do a foreclosure on you. They want to keep you in the house. Nobody wins in that situation. So when implemented, the payment supplement will allow mortgage services to temporarily reduce a borrower's mortgage payment by using funds from a partial claim, okay, which enables the borrower to access up to 30% of the outstanding balance of their FHA-insured mortgage. The partial claim amount is placed in a junior lien position, meaning like a second mortgage, okay, and paid back when the homeowner either sells or refinances their home at a later date. So maybe when rates drop down, right, as long as your mortgage payment history is nice and clean and rates go back into the fives, what have you, in the next 12, 18 months, I hope, then you can refinance it, and then that's when that thing could get paid off. So they're going to put it into a second lien position. One thing they do not say is when you do that refinance, whether it has to be classified as a cash out or a streamline or a rate term, I would assume it's rate term, okay? A rate term is simply just reducing your current interest rate and your mortgage balance to get a better payment. Cash out could be triggered when you're paying off not only your primary mortgage, but a second lien position. They do not discuss that in this new mortgagee letter, so that is something I'm going to try to get some information on and see if that's going to be an issue when you guys do that refi. So again, guys, if anybody out there that has an FHA insured mortgage, if you are in trouble, don't keep it a secret. All right, do your best to not only catch up the payments, but if you need to apply for this assistance, check it out at HUD.gov, and they will have some more information out there for you to keep you in your home. All right, so mortgage rates. Let's talk about that briefly, guys. So they have hit the highest mark since the mid-December. It was really nice. In January, we got a nice little dip in the rates, and then whoop, back up we are because of the consumer price index. Inflation's a little up right now. 3.1 was the last CPI that came out a couple weeks ago. So rates kind of jumped on us a little bit. They were, again, like down in that 6.5 range. Now they're in that 6.9 to 7% range again. So hang on tight because Fannie Mae's rate forecast is out, and they're still looking pretty glass half full. So let's look at this. So they think Q1 will be sitting at 6.5 at the end of Q1, which there's not much time left, right? Q1's in a month, at least the end of it. Previously, they thought it was going to be at 6.4, so they're thinking 6.5. So I mean, they adjusted upwards a little bit. At the end of Q2, they're thinking 6.3. Q3, they're thinking 6.1, and they still think by the end of this year that we'll be sitting at 5.9%. That's the average rate. That's what they're expecting across the board. Okay, so we'll see what happens. There's a lot of factors that can come into play, whether consumer price index or inflation is still showing its ugly face and having an impact on the market. Then this may not apply. But maybe Fannie Mae knows something that we don't, because in 2025 they think the decrease in the rates kind of slow, right? Because they're thinking 6.5 at the end of Q1, possibly 5.9 by the end of this year. Well, next year they think 5.7 at the end of 2025. So it looks like it kind of pumps the brakes a little bit, and the decrease isn't going to happen quite as fast. So that's something to keep an eye on, guys. All right. So we still think end of this year, beginning of next year is going to be a great time for a refinance opportunity for any of you homeowners that have been buying in the last 24 months. So yeah, keep your eyes out there. and stay in touch with your local lender on rates and rate forecasts and what it's looking like. So on this topic, more homes are hitting the market as well. We are in a cyclical industry, so as we go through winter, things kind of slow down a little bit. But new listings rose 10% year over year, ending over the last 4 weeks, ending February 18th. So that's a positive note. I mean, one of the biggest issues we face in our industry right now is still the supply and demand issue that we have that's still creating these high prices because there's just not a lot of supply out there. So the good news is across the country, new listings rose by 10%. We may not quite be feeling that in our market locally, but as the spring season spring approaches and we approach spring selling season, they do still believe, even with rates sitting in the upper sixes, that we're going to get an influx of new listings to hit the market, which is just going to help a lot of different things here, hope fulfill that need, and hopefully create some more competition out there and push down or keep the home prices stabilized in our market. It might help us prevent any kind of over ask or multiple offer situation by getting some more houses on the market. So we shall see. So those are some of the forecasts, because Zillow believes that a home price forecast is looking semi-positive here. So Zillow is issuing a revision predicting that over the next 12 months, home prices would rise 3.5% instead of their previous forecast of negative 0.1%. So originally they thought that we were going to get a decrease in home valuations due to homes maybe sitting a little bit longer and all of that, but now they're saying they believe that it's going to be stabilized and they might go up slightly. So we shall see. And they may be thinking this because, Fannie Mae came out with a new rate forecast, and if they think that rates are going to drop significantly, that more people are going to jump in the market. Now, the only way that that's going to offset is we have the same amount of listings that offset the amount of buyers that jump into the market with that lower rate. So we'll see here. All right. It's going to be an interesting 6 months, to say the least, as we approach our spring selling season and moving into summer. So that's it for us this week, guys. Remember, check us out on YouTube and subscribe. We are also out there on Spotify and Apple Podcasts, and we'll see you all next week.